Greetings traders, and welcome back to another In-Depth with Chris episode. In today's discussion, we will be talking about the maintain consistency rule. If you plan on passing the Gauntlet or Gauntlet Mini, this is a rule that you should be quite familiar with, as it is one of the rules that will be required to be adhered to in order to pass. So make sure you pay attention if this is in your future, and if you haven't checked out our Gauntlet Mini, I strongly suggest you do, because it allows you to trade with money that isn't even yours, as long as you have the skills. But without further ado, let's go ahead and dive on into those disclaimers so we can work our way into that juicy material that follows. The biggest mistake that beginning traders tend to make is becoming overconfident after they've made a substantial profit off of one or just a few trades. In many cases, this is usually more as a result of luck, the winning of these trades that is, than a result of skill. The best traders, investors, and fund managers worldwide are able to do what they're doing on a consistent basis, and that's what makes them so good, because when the dust settles, it's not that they win every single trade that they're taking, it's the fact that they're able to be winning after all of the trades have cumulatively been averaged together, and they come out on top. And that's what the maintain consistency rule is all about, and it is something that we absolutely do incorporate into the Gauntlet and the Gauntlet Mini program. So what exactly is the maintain consistency rule? Well, the maintain consistency rule states that no single trading day can account for 30% or more of the total profit and loss over the course of the examination. This means the rule guarantees that you deliver results consistently rather than a few massive trades and simply not trading after that point. It manages to minimize the luck factor when we implement this rule, because it's forcing traders to realize that the idea isn't to just hit some gigantic lottery ticket, because that's not how trading works. And here at Earn to Trade, we're trying to make sure that traders are prepped for real-world trading, and this is an aspect of real-world trading. Luck is not sustainable. Skill is sustainable. The maintain consistency rule has been in effect for the Gauntlet Mini since April 1st of 2020, and we're quite happy with the results that it has provided for both us and our traders who continue to follow it. The maintain consistency rule is based on a daily calculation of your profit and loss, as well as the total profit of your Gauntlet Mini account. The rule states that you won't be allowed to pass the examination of your profit and loss for a single day if it accounts for more than 30% of your total profit generated. The daily profit and loss is taken into account regardless of whether the current account balance is below or over the starting one. So let's talk about how it works in practice. If we were to say that we were trading on, say, the $100,000 Gauntlet Mini trading program, and our total profit that we were looking to achieve was $10,000. So we're looking to reach $10,000 in profit starting with a $100,000 account. If we made $3,500, so 3.5K, if we made 3.5K in a single trading day, well, that obviously represents somewhere around 35% of our total profit. If we profited 10K and 3.5 came from a single day, 3.5K represents more than 35%, or more than 30%, I should say. It represents 35% of our 10K of profits, and that exceeds that 30% maximum that is allowed. Now, just because this is the case, that does not automatically mean you fail your evaluation. Instead, that means that we need to continue trading to make that ratio lower. As we decrease the percentage share of the profit of that one 3.5K trading day, this will lower what it represents as a percentage until at some point our profit is high enough that 3.5K on one day will not represent 30% or more of our total profit generated. So why does the maintain consistency rule matter? What makes it important? Well, It helps us become better traders in the short and sweet answer. Although financial markets move in cycles, no cycle is identical to the previous one. Market dynamics change, which means that trade setups are unique and really hard to replicate over time. The best way to navigate the changing market environment is by building a sound trading strategy that delivers more often than it doesn't. The maintain consistency rule is designed to prioritize consistent performance over one-off profits. Its goal is to award your discipline and the willingness to follow a trading plan and remain on track by adhering to your predefined rules as you adjust them according to the market conditions. On the other hand, it helps minimize the speculative element in your trading style. It also lets you build habits that will ensure your long-term success, which is good for you as a trader, not just for us as a company. It does so by putting a cap on how much one-off trades affect your total profit. This reduces the effect luck plays in your overall trading performance. This is especially important for beginner traders who may often fall into the trap of overconfidence. Many traders out there have, at some point, thought that they somehow cracked the code of the financial markets just because they made a significant profit from a one-time trade. However, the truth is that extreme one-off profits are more often than not a matter of luck rather than skills, and that's because the specific momentum or opportunities that gave them may not ever come back again. This means relying on the same exact trading philosophy without allowing yourself the ability to be dynamic with the dynamic market conditions means that you're going to be caught up in a situation where you will never be able to find that success if you lock yourself into something while that something continuously changes and you don't. If you think of the industry's finest, you will see that most of them, or think about most of them, as having a reputation for being consistently profitable, not just for having a few impressive trades. Warren Buffett's investment and Jim Simmons' funds have been reliably delivering profits for ages, and they haven't been doing this with one large win and then coasting off that win for the last 10 decades. So how do we maintain consistency? Well, to maintain consistency, the first thing we need is a sound trading plan. A sound trading plan means a strategy that is tested and fine-tuned to work within our preferred market. It is a tailored strategy to our trading style as well as the assets specific that we're interested in trading. It needs to be time-tested to ensure that it can deliver under different circumstances. It also needs the right risk management tools to allow you to mitigate losses and get out of the market as soon as it turns against you. On the other hand, a sound trading plan isn't a universal solution that you can apply equally when trading bonds, stocks, futures, ETFs, and Forex. Generally, these are all going to involve different degrees of trading plans. You should know that it is also something that can't work 100% of the time. Nothing we do in trading will ever be expected to work 100% of the time, usually much less than 90% of the time. Inevitably, it will lose money in certain situations, and we need to be prepared for that. What is essential is to make sure that we have done everything right that we can control on our end when constructing our strategy, and we don't let our emotions get in the way. We want to make sure that we are sticking to our trading plan no matter what and ignoring all distractions along the way. For example, the number one thing to avoid is to jump on a high profit potential trade the second it emerges if it goes against our trading plan, that is. If we see something that is juicy and profitable but it isn't something that we prepared for, it may not be an intelligent decision to take it because we simply have not prepared for it. And sometimes our brain will tell us that even though it looks guaranteed, it might feel that way. The reality is, if it was guaranteed, we probably would have already incorporated it into our trading plan. When we maintain consistency, it allows us to continuously monitor the results that we're achieving, and we can carefully dissect those results and decide if, when we are seeing losses, if they're just a result of variance and just a result of the expected losses, or if we're losing slightly more than what we should be expecting and might need to alter our strategy slightly in order to keep up with the ever-changing market dynamics. So in short, even though the maintain consistency is a rule that we have attached to our Gauntlet Mini experience, It's a rule that should most likely be employed by traders of all diversities all around the world. It's a rule that allows us to make sure that we're doing things on a basis of skill instead of a basis of luck. It is not a rule that you will have to abide by once you pass your Gauntlet experience. However, it is something that we strongly encourage you adhere to just for the sake of how beneficial it can be and is to professional traders around the world on a daily basis. If you always are aiming to be able to replicate your results on a consistent basis instead of having random spikes up and random spikes down, your trading life, as well as the amount of gray hairs on your head, will be an awful lot easier and an awful lot less. But until next time, folks, good luck in the markets. Happy trading. I'll see you soon. Bzz.